May began with the collapse of another large bank in the US, First Republic, and dramatic falls in the share prices of several other regional banks, but ended with the euphoria of the rapidly unfolding AI boom. Headline market returns for broad asset classes disguised considerable intra-month volatility. The broad US equity market was little changed in May, with the S&P 500 index returning 0.4%, while weaker markets in Europe, the UK and Asia, along with a recovery in the dollar, held back the MSCI World Index of developed markets, which fell by 1%. Emerging markets fell by 1.7%, pulled down by a drop of 8% in China, as the post-COVID growth surge appeared to be fading. But within equities, a very narrow cohort of stocks dominated returns. The extraordinary success of ChatGPT following its launch in November last year is leading to a surge in demand for high-end processors to power AI applications, and an acceleration in the race to embrace the AI boom. This was reflected in extraordinary share price gains for the major beneficiaries, most notably Nvidia, a leading supplier of processors, whose share price gained 36% in May, taking its return year to date to 160% and a market cap of over $1 trillion. The FANG Plus index of 10 major US tech stocks was up by 17%, a long way ahead of the marginal gain of the broad index. It's been an amazing 5 months for US big tech following the sharp falls of 2022. The FANG Plus index has returned 61% year to date, leaving it only 7% below its all-time high of November 21. The 5 largest stocks in the US, Apple, Microsoft, Alphabet, Amazon and Nvidia, all of which are constituents of FANG Plus, now make up 24% of the S&P 500 index and 16% of MSCI World, a concentration level which presents challenges for active managers holding broadly diversified equity portfolios. So far this year, the S&P 500 has returned 9.4%, but the scale of the contribution made by big tech stocks is reflected in a 1% fall in the S&P 500 equally weighted index. Away from the excitement of AI, markets were more subdued. The federal debt ceiling problem went down to the wire, but has been resolved at least until 1st of January 2025, with federal spending capped and the ceiling suspended until then. Beyond that, investors focused increasingly on rate hikes and fears of more to come, as inflation in the US, Europe and UK proved more persistent than expected. Headline inflation continues to fall, helped by sharp falls in energy and other commodity prices, and easier comparisons with year-earlier figures. However, core inflation remains more persistent and stickier than expected, currently standing at 5% and 5.6% in the US and Europe respectively, while in the UK the latest reading was well above expectations at 6.8%. The continued strength in economic data and overriding priority to rein in inflation gave central banks the conviction to maintain hawkish policies. During May, the US Fed, European Central Bank and Bank of England all pushed ahead with rate rises, in each case 25 basis points. The Fed is closest to a peak in rates, with the possibility of one more rate rise of 25 basis points around the corner, followed by probably a lengthy pause, whereas the ECB and BOE both made it clear that the further rate rises are planned, with markets pricing in 100 basis points more for the UK, which would take the base rate to 5.5%. Policy rate rises, along with growing concerns that rates will stay higher for longer in the face of persistent inflation and resilient growth, pushed bond yields higher over the month, leading to negative returns for most major fixed income indices. Yields rose by around 20 basis points in May in longer dated US Treasury maturities and by 40 basis points on shorter dated bonds, shifting the yield curve to a wider inversion. With dollar cash now yielding close to 5% and 2-year Treasuries 4.4%, positive real yields are, or soon will be, available on the world's preeminent risk-free asset, and longer dated bonds are already providing decent real yields on expected inflation levels. This means that for the first time in years, government bonds are offering reasonable and increasingly attractive valuations, and can again play an important role in multi-asset portfolio construction and risk control. Markets have generally performed above expectations so far this year, especially against a backdrop of high and sticky inflation, aggressive tightening of monetary policy, and difficulties in parts of the banking sector, of course. With valuations of big tech getting stretched, elsewhere valuations are reasonable, but face increasingly tough economic conditions as the long stretch of monetary tightening over the past year or so begins to bite. A sharp economic slowdown seems highly likely, and a recession in coming months cannot be ruled out. But this does not seem to be fully factored into market pricing. Against this backdrop, while we see valuation opportunities opening up in some asset classes and specific investments, and believe that recovery lies ahead over the next 12 months, we continue to be patient before adding to risk assets.
May was a negative month for global markets. The continued geopolitical tensions, an uncertain outlook on inflation and interest rates in the West, and a sluggish economic activity in China put a lot of pressure on global investors, who now left wondering whether they were perhaps too early in calling the start of the next bull run. The Harmony funds posted losses of between 0.5% and 2.5% in May in local currency terms, with only marginal differences across regions and risk profiles. The two Asian funds were the worst performers, with a higher exposure to the Chinese market taking its toll, whilst the European Growth Fund led the pack, thanks to decent manager selection, but also benefiting from a weaker euro. A notable outperformer, despite a high equity allocation, was the Sustainable Growth portfolio that was helped by a higher exposure to resilient, high-quality names, but also a lower allocation to China. The global equity and sustainable equity funds lost about 1.5% and 2% respectively, both a little bit behind benchmark that lost only 1%. However, year-to-date numbers are much better, especially across the high risk profile portfolios, like for example the two global equity funds or the many multi-asset growth ones. And like Andrew mentioned, it was a very narrow market with only a handful of US mega-cap technology names that were able to deliver strong returns on the back of a big hype around artificial intelligence and especially its consequences on future growth. And in fact, our best performing investment was the Jennison Global Opportunities Fund, up 4% in May and about 24% in 2023 so far. They are a US-based growth equity manager held across all Harmony funds through the Momentum Global Equity Fund. Other strong performers, much like Jennison, in fact, benefited from their technology and growth exposure. For example, the Old Spring and Vulcan funds in the US portfolio and Comgest in Europe, who are up between 14 and 18% so far this year. On a more negative note, a key detractor from performance was our exposure to the Chinese market, be it within fixed income with the Ashmore Asia High Yield Fund or within equities through the Binyuan Greater China Fund. There was a lot of exuberance last year about the big Chinese reopening after the COVID lockdowns, but that's failed to materialize so far. We have seen a bunch of economic activity numbers disappointing markets, and if anything, the Chinese economy is now at risk of deflation, with the central bank now looking to cut interest rates and stimulate growth. Both investment strategies are held across all of our multi-asset portfolios except for sustainable growth, but only in a small weight. And on the bright side, the Ashmore Fund now trades at a forward dividend yield of about 50%, so the future looks better. Looking forward, we're increasingly seeing opportunities arise in different parts of the market as opposed to the past few years that instead were all about growth equities and nothing more beyond that. We have increased exposure to government bonds, now offering high yields and very little risk, and to specialist financials where instead we're being compensated with very high income in what is a complex but often underappreciated asset class. We have been positive on Japanese equities for a while now on valuation grounds, but also given the improvements in corporate governance and shareholder returns that we have observed over the past 2 or 3 years. And finally, we've been reducing exposure to credit risk where markets are, in our opinion, a bit optimistic and could in fact face some higher volatility as defaults pick up. As always, diversification and careful portfolio construction remain key, especially to navigate the coming months in what is not an easy economic backdrop, in my opinion.